I will be brief. We were told we only had 6 minutes. I will admit I was caught a bit off guard. Originally we were told that we had 10 minutes, and then it got cut down to 7 minutes. And then as of yesterday, after I prepared the presentation, I told it was only 6 minutes. And I must be honest, I can't help but think about the movie, if any of you recall, Something About Mary, where Ben Stiller's character picks up the hitchhiker, and the hitchhiker unveils his plan about how he's going to revolutionize 8-minute abs. And he comes up and says, I got it for you. It's 7-minute abs. And Ben Stiller says, well, what happens if somebody comes out with 6-minute abs? And the hitchhiker says, no, man, hell, you can't get your heart rate up in 6 minutes. Seven's the number, 7-Eleven, 7 dwarves, 7 little chipmunks sitting in a branch eating peanuts on your uncle's ranch. The children's song. So, that said, now that I've burned a minute, I'm going to breeze through this in 5 minutes, but I promise I will be effective and informative. So, without further ado, we will get right into Orange County. If you see Orange County up here, I'm sure most of you know, you're surrounded by LA County, San Bernardino, Riverside, San Diego. Orange County consists of 308 million square feet of industrial product. You can see it's highlighted a little bit. The industrial core is really in northern Orange County, central Orange County, and a little bit of the product down in South County and San Clemente. And then it also consists of nearly 147 million square feet of office, and you can see those are the primary pods, larger and smaller. We'll move forward to our statistics. Now, I don't want to spend too much time on this because I don't really like the slides that are static. This really looks at a static picture much like a photograph. It's a moment in time. It doesn't really capture the context of what's happening today and going forward. The most significant aspects you'll see here are really the absorption, which are covered in red, and all of those are negative numbers. But again, it really doesn't tell the picture of what's happening today. As you see, the lease rate trends throughout 2010 were downward, but a good portion of that was because there were actually deals happening. In 2009, late 2008, nothing was happening, so there wasn't really any significant trends other than nothing happening and significant absorption. So if any of you have questions on this, I'm going to keep moving, but this will be provided afterwards. In highlights for 2010. Sales transaction volume was up 67% from 2009. 92% of that user sales, predominantly the SBA-driven incentives, and the 90% LTV, 10% down financing. Absorption for Q2, Q3, and Q4 were all positive, totaling just over 700,000 feet. And if you go back to the static slide, this is what I mean. It doesn't tell the picture. Even though we had negative absorption in Orange County for industrial, the last 3 quarters we actually posted 3 positives in a row, with the 4th quarter actually being nearly 450,000 square feet. That doesn't sound like much for people from the IE or even LA. You're seeing almost 5 million square feet or over 1 million square feet. Well, keep in mind that Orange County's vacancy rate is only 6.6%, so you don't have that much really to absorb. At the peak, we had about a 4%, just under 4% vacancy rate. And at that point, that's not even healthy. You can't absorb anymore, so that's really telling of where we are today. Gross activity is up 25% over 2009 in the large transactions as they started to return. SBA financing again, paired with historically low interest rates, drove the sales volume. Lease for a buy analysis finally makes sense again as brokers. We can actually use them because they really do make sense. Again, historically low interest rates, and then really low basis that's really returned back to 2003, 2004, which makes it make sense. And then Port of Los Angeles activity is up 16% over 2009. Good effort, do better. These are the negatives. I'm not a negative person, hopefully not foolishly optimistic either, but I did change that headline. Property values and lease rates continued to trend downward, but again, we're starting to see stabilization because deals are actually happening. When you're in a low vacancy environment relatively, again, 6.6%, once deals start happening, you absorb some of the space, you'll start to stabilize, which we're seeing. Purging of non-performing loans, this has been a really big issue, and we still have not begun to see them really purged in mass. SBA is not taking action, and the groups in the first on these 504 loans are foreclosing when necessary or selling notes, but it hasn't come out in mass, and who knows, we look forward to seeing that this year, but if 2008 or 2009 was any indication, it's picking up a little bit, but it's not in mass like we expected. And then the employment picture, sluggish about 2010, but better in 2009. After we made this presentation, there's a couple of significant indicators. Google announced yesterday, I believe, 6,000 new jobs, that it will be hiring 1,200 that are coming to Orange County. So that will be a significant boost in the technology industry. Also, there's FedEx Ground, their freight operations, that they will be looking for about 150 to 200,000 square feet of expansion space. So if that's any indication of what's going on in the market in organic expansion, we expect to see that throughout 2011. Moving forward, transactions. I'll blues through these. These are sale transactions. I picked an investor that was a note purchase, a user, and then an office deal. The investor purchase was unique. This was a 280,000 square foot asset in East Anaheim, Class A facility, owned and occupied by a user called Galleria. Went bankrupt. Saris Regis, who had owned it previously, did the end around during a receivership managed bid auction. Their B of A was a lender, bought the note for $72 a foot on spec, and ended up securing a group that had been out in the market, not necessarily tenant in tow, and that will be one of the lease deals on the next page. 2164 Batavia was an investor-owned property owned by Young's Market back in 2006. Orchard Properties purchased it, sat vacant for quite some time, and they ended up selling it to a user at just about $90 a square foot, which was Paper Mart. Great headquarters facility, but again, the facilities that have sat the longest are the ones with really significant office, and finally they're getting absorbed. And then 2211 Michelson, that happens to be where our office is, 360 Partners, and that caught the headlines because it was a really strong, stabilized asset with above market rents, but it absolutely captured a premium in the market. And Kilroy purchased that with a 7.2% in place with a really aggressive acquisition with $1 million hard, really up front in a very short due diligence period. Moving forward, lease transactions, 3454 Mira Loma. This just happened. It actually got posted in 2011, even though it was inked in the end of 2010 in the fourth quarter. This is Panasonic relocating from Pomona. A very straightforward deal. Nothing quirky about it. 66 months, 6 of those free, 39 cents net up front with a 37.7 net effective, and no TIs, 3% annuals. Really straightforward deal. And then the second deal is the La Palma deal, where Straub Distributing ended up being the tenant that occupied the building that Saris Regis purchased under a note sale, and then somewhat of a friendly foreclosure with the user borrower that was in it. 56.3 cent net effective over 15 years, but it shows also $14.2 million of amortized TIs over 6 months, which actually boosts it up to a 68 cent net effective if you take that into consideration. So that was a pretty marquee deal. Both of these deals just transacted in the fourth quarter, which understandably gives you nearly 500,000 feet of absorption, and really puts us back on the market with large transactions taking place in Class A buildings. In the Class A environment, we have, you can call it about 3% vacancy rate. Moving forward, where we see for 2011, the year of recovery and opportunity. Again, not trying to be foolishly optimistic, but the static picture of the stats from 2010 and where they currently stand, I don't think it really paints a picture of what's really happening on the ground today. Speaking with most of you here, it's great. Activity's up, foot traffic's up, deals are finally starting to take place. The large deals that have taken place is a testament to what's really happening in the market. So to take a negative absorption number and downward trends in rates and property values is really, it's foolish to buy into that. And we really think that's a great opportunity moving forward. So we expect strong tenant demand in the industrial sector, stabilize the rates with concessions, and then we actually expect a growth in rents towards the end of the year. And this, again, may sound foolish, but if you look in the Class A environment, you see people in C's and B's moving up into the A's, and once that product dries up, again, only 6% vacancy, 6.6% vacancy at this point, they've got to take the space. And if certainly we felt we've hit bottom, and we expect to see rent growth at the end of the year in the A, B plus product. User sales have remained strong despite the incentives lapsing. Low basis, and the analysis, lease versus buy analysis, makes all sense in the world. REO and short sales to increase as banks looks to purge non-performing loans. We get next slide here, Martin. It's not working here. Property values stabilize will remain at current levels because in the small building for sale environment, there's still quite a bit of property, and we have yet to see short sales are flooding the market, and there will inevitably be these foreclosures and note sales. And then Martin, one more time. Investor demand remains strong due to a lower cost basis and then the inevitable future rent growth. And I strongly believe that some argue that it's just an overcapitalized market in the industrial and stabilized property, but I call it a paradigm shift. And if we look back from the 90s before my time, REITs, nobody really understood what a REIT was. But in today's environment, REITs are here to stay. Capital is here to stay in the real estate environment, especially in land-constrained markets, and this capital will continue to flow in. And with that, there will be continued cap rate pressure, holding cap rates down, probably tracking interest rates as those go up, and that's about it. So with that, that concludes Orange County, and look forward to crossing paths with you guys throughout the year. Thank you very much.